Excellent. So next up, inflation watch here. So the debate over inflation is reaching peak confusion. I don't know if you're feeling the same way I'm
A
here.
little bit.
Yeah. Some say the Fed needs to hike again. Others say spending cuts will do the trick, and tariffs are being framed as a necessary evil. Meanwhile, gold and the dollar are falling together, signaling a shift in sentiment. So WTF is going on? Now, I've been screaming about this for the last couple of months that I think inflation is going to pick up. But really, I was sort of thinking that I was assuming that the government on the fiscal side would all be like it was before, that everything was just talk, and no matter what, you're going to come in, they're going to pump, cut rates and everything like that. That doesn't seem to be happening over here. It seems to be
Mhm.
this weird war of fiscal spending and long term rates. I never thought I'd hear about the government think about like actually do anything about long term rates. I'm not sure what to think about. So what I'm going to do is bring up just this conversation. I thought it was uh, super representative of the back and forth that people really don't know what side to land on. Let me just pull that up here for a second. So this is there's an interview on CNBC by at least one person I really know and respect that I thought was particularly interesting. One second here, or he's making the argument that the Fed should raise rates.
You were not convinced that the inflation bugaboo was laid to rest.
I wasn't at all, and I think the only surprise to me was so many news outlets yesterday calling it a surprising upturn. There's no, as you said before to Rick, there was nothing surprising about it. My principle is very simple. If you double the balance sheet at the same time the fiscal deficit is being increased, as in 2020, 2021, and take interest rates down to zero, forget it. You have created inflation. It is not a case of you're depending on housing versus non-housing, and housing cost is coming down. Eggs. Yeah. Something else will pick up because there is a lot of liquidity. So there is nothing surprising. And I think the Fed should react next month at its meeting by announcing a hike in the interest rates.
Next month,
March 19th.
It'll never happen.
They will not happen.
Because it makes too much sense.
They never do what I suggest they do. September, I said they should not cut at all, and Powell cut by 50 basis points, and now I'm saying he should announce an increase.
Lindsay, you have the floor.
Okay, so that just sets the idea. He's the inflationary guy. He's saying they should raise the rates. Now let's hear this other side.
Rick talked, he talked. I'm sorry, I had to do Sheree because I had already talked to him, but take it away.
I think when we look at this ascending trend in inflation, it first and foremost calls into question whether or not the Fed stops short of a sufficiently restrictive level. As you long know, we called for 6% at a minimum. The Fed was so concerned about inciting negative growth on the way up that they lost focus of the second side of their dual mandate, which was reinstating price stability.
It wasn't the election, was it?
No.
They caused them to want growth.
I think they realized they made a policy mistake on the front end. They were late to the inflation taming party, and they didn't want to leave their legacy as making a second policy error, raising rates too high. But in that concern, they did end up making a policy error. We stopped short. We didn't raise rates high enough. And now we're still contending with above target inflation, which we're going to continue to struggle with for some time. If the Fed doesn't get this under control, the risk now is not necessarily a recession or outright negative growth, but the risk is eventually choking off upside potential, pushing us into a stagnant economy. Sluggish growth, still elevated prices, the very definition of stagflation.
If tariffs are inflationary, and if deficit spending is inflationary, and we're going to extend the tax cuts maybe permanently, we were just talking about that, how is anything that you're hearing from the Trump administration going to help with what we already know is a problem? It's already a problem.
Remember, tariffs in and of themselves are not necessarily inflationary. A one-time price hike lacks the upward momentum needed to incite inflationary pressures. But
if you try and pass those prices on to consumers, if you try and do it down the line, it would.
Correct. And then if we get into this back and forth tit-for-tat retaliatory relationship.
But Joe's right. The inflation
is there anything that's going to help? Is Doge going to help?
If we can find enough line items, if we can find enough areas to offset that expansion in other areas, that loss in revenue from other initiatives, then absolutely.
Is it going to help the consumer at home?
Well, it
can offset it because it lowers their tax bill. Is that the thought?
Absolutely. But it's going to depend on where we see the cuts, where we see the increases. And there has to be an equal offset. And that's the big uncertainty that the market is grappling with right now. Can they?
All right, so you can just hear it goes on and on. They go back and forth, like could be inflationary, could be not, could be inflation, could not.
Sounds like a whole lot of speculation, though.
Yeah, so that's the whole thing. The whole other than controlling the interest rates, the Fed, their biggest tool is forward guidance, is talk in the market into lowering the uncertainty of what the market thinks will happen in the future in order to help control longer term rates and behavior within the markets. And they can't. We have the situation here, if we just take a look at this article from the Wall Street Journal, where so we have here two major indicators this week, both showed inflation running a little hotter. So CPI was up, but then at the same time the CPI was up, PCE was down. So core inflation is down, and so we're ended up in the situation where the Fed likes to the Fed likes to look at whatever metric favors their narrative. They'll be like, so if they needed to make a move because of inflation, they would cite uh, CPI, and if they don't want that, they'll cite PCE. So when you have core going down, where it's not taking into consideration what is it, energy and some other factors for CPI, and the Fed is going, well, we're going to pause because that looks like it's going in our direction. Then you sort of like, well, what are the market players going to do? What are they going to move? Now,
Maybe I haven't been paying that close of attention, but I'm pretty sure the Fed always prefers PCE over core inflation or CPI.
yes, but they'll cite it when
Okay.
they'll cite it specifically when it supports their thing, and if not, they'll say something like inflation metrics are going higher. But you're right, they never actually cite CPI specifically.
Right. So I agree. I think what's interesting at this point is the way that the futures market is pricing this out. At the moment, it feels like there's a very high probability we remain paused in March's meeting. 19th of March, 97% chance of a pause. 7th of May, an 80% chance of a pause. It's not until we get to June that there's about a 50-50 shot that we might see a reduction in rates. At least that's how the futures market has priced it out. And typically they're pretty spot on with their predictions. Maybe not so much so far out, but by the time we get to May, we may have a better prediction on where we expect rates to be in the future. That said, what I'm taking away from this is we remain paused until we can see more data coming in, at least for the next two Fed meetings. And that just adds to this confusion here, because pausing just feels like this indecision point where we're not sure what action we need to take. We're not sure what's happening to the economy. We're not sure how Trump's policies are going to impact inflation. We have to wait and see. And that's kind of the game I sense we're playing right now.
So I've just like you were saying, it's all uncertainty, it's all guesswork. I have a couple of questions that are floating through my head that I'm going to be paying attention to over the next couple of months. One, the tariff game or the tariff rhetoric seems to have tamped down a little bit.
A little bit.
They're like, okay, let's pause. We'll give you 30 days to figure out what you're going to do, and maybe we'll do this tit for tat. So it's like, okay, what's going on over there? And we can tell that that's the case because the dollar would not fall otherwise. We got a lower low on the dollar. Second, we have the Ukraine war might be like over as far as American involvement inside of that war, as at least fiscally. In fact, he's trying to like request Trump is trying to request $500 billion worth of like rare earth materials or whatever in order to compensate for the money that was spent. Okay, whatever. If he's not putting more money into it, that flight to safety that normally happens during like wartime periods where the dollar goes up and gold goes up, you would expect that to reverse, which is exactly what we saw. We saw gold drop 2% yesterday. We saw the dollar drop as well. Right, the day before that, with the CPI information, we had the dollar go up higher because of the inflation. Right, we had this a little mini blip within futures and in crypto and within currencies because of it. So the major players are trying to figure out. It looks like they're actually basing the decision based on what Trump is going to do. Like that seems to be the main thing that the markets are paying attention to. Then you add to that, there was an interview with Elon. I won't play it now, but Elon Musk did an interview with Donald Trump in the this week, and he says we can cut the spending for the government by $2 trillion. Sorry, $1 trillion, and we could increase over the next year productivity GDP by 1 trillion. And so he's saying if you do that, then you don't actually get inflation due to fiscal spending. So then people go, wait, so then if we don't have inflation and there's domestic growth opportunities, and the Fed is sort of like saying, well, we're just going to pause, we're not really worried about anything. Well, that reduces uncertainty with a bias towards productivity, and you should see stocks take off, which is what we're seeing in the AI space, which is
Sure.
what we're seeing in a bunch of these places where there could be squirts of money going in. It is. So I'm all of a sudden like pretty bullish, pretty significantly bullish. So then the final thing we take a look at your your liquidity indicator,
Mhm.
right? And that ticked up this week to a new high, not an all-time high,
Not a
but
new high. Okay.
No,
Yeah.
just
Yeah. We're starting to head upward. Yep.
yeah. So that's like, hey, liquidity can be increasing, uncertainty decreasing, productivity up. This is maybe full on run a new, like the
Hey,
.com run up.
We've talked about this before. We've been in a bullish run for quite some time now, and we haven't pushed, even if you just look at this from a technical perspective on both the NASDAQ and the S&P 500, we still haven't posted lower lows yet in a way that's making me feel like we've started to form a reversal in the market. Right. So until we receive a signal otherwise, it's still a bull market. I'm still on this rise upward. And I'm right there to say that I fully support the idea that we could see a continuation from here. I would be interested to see if there is a pullback of any kind. It's going to be coupled with negative news of some kind. And in general, when we see tight ranges of low volatility like this, ATR is starting to recede. The options market will be obviously a good indicator of where we're starting to expect volatility to show up. All of that said, it's going to be a pretty big event if we do finally pull back. I would fully expect the pullback to be pretty sharp and pretty expensive for anybody who's still holding to the long side and doesn't have a short hedge against that.
This is the part I hate. I hate that before the major drop because of some major event, you have this blow off top. Like that happens so often. You have the spike up, blow off top.
That's
and
right.
There's no way to position for yourself for it exactly. I
But
just want to play
the sentiment that you're describing right now is what has me concerned. When everybody thinks, oh, well, this bull market's going to continue forever, that's exactly when you should start preparing for the worst.
Well, that's why Kim Carson, I got to bring him up, I guess, every Friday. I was planning on talking about him today, but he says calls for the upside and position for the short side.
Sure.
So I just want to play this last clip here from Druckenmiller.
Sure.
And he was on CNBC the other day. I thought it was interesting to get his view because he was very big over the last year about shorting bonds. So let's just hear what he has to say here.
When you spoke at a conference and said that you were shorting U.S. Treasuries, I think it was 10 to 15% of your portfolio at that time. You still shorting Treasuries based on what you're watching?
I still have a short in Treasuries. I know a lot of people have been surprised by interest rates rising after the cut. Of course, we weren't, because I thought the Fed was making a mistake, and I was worried about the same animal spirits we've been talking about, and of course, our horrendous fiscal situation. Having said that, we've come quite a ways. I think we're probably in the 7th inning, but sometimes you can make a lot of money from the 7th inning to the 9th inning. And who knows, if the Fed stimulus into a melt up in asset prices with the kind of animal spirits I talked about give you upward inflation, which is not our forecast, but we're definitely open-minded to it, and we're not expecting lower inflation, that could tip the bond market and create a problem. So we're still short Treasuries, but we're certainly not pressing the size of that position now.
You've said in a perfect world, Stan, that you're not a fan of tariffs, but that it could be potentially the lesser evil if it's done in moderation.
Yeah, I don't want to exit this interview as tariff man.
Yeah.
Good call.
In a perfect world, I would not be for a 10% tariff, but we're not in a perfect world. As you know, we have a big fiscal problem. Mandatory spending plus interest expense is literally 100% of revenues right now. And both sides of the aisle have said they are not about to cut entitlements, which is in the room. Having said that, because of that, we need pay-fors. So our main choices are an income tax and a consumption tax like tariff. So when I say tariffs are the lesser of the two evils in terms of those two, because we have a fiscal problem, we need revenues. Tariffs will generate revenues. We also have a private savings problem in this country. They're far too low. So I think a lot of economists who are out raising the alarm bells about tariffs would probably be fine with a consumption tax. To me, tariffs are simply a consumption tax that foreigners pay for some of it. Now, the risk is retaliation, but as long as we stay in the 10% range, and I think so-called fear of Donald Trump, I think the risks are overblown relative to the rewards. The rewards on.
All right, so correct me if I'm wrong. That sort of touches on what you were saying last week, that consumption tax might be more palatable to people, because it's like, well, why shouldn't it be on the people who are spending, who have the money to spend?
Only if it's offset by a reduction in income tax. If the two happen at the
Right.
same time, that's detrimental to Americans.
I understand.
If they're, in other words, if tax rates remain the same, income tax isn't reduced, then effectively all you've done is increase the cost of purchasing goods over time.
Right.
So that would be inflationary. But if we're able to offset that, then yeah, I think that rewards savings. That's what we want to see. That rewards, ultimately earning more capital to keep for the household, or earning more income to keep for the household. And then, obviously I want to see that. I think that ultimately leads to more investments over the long run. Anybody who has a little more money available and they're prudent in their financial future is going to invest more in the market as a result. And then if you decide to spend, which of course is now being disincentivized, if spending is disincentivized, that ultimately leads to a higher savings rate. But it could also be impactful from a consumer spending perspective, which, you'd have to keep an eye on those sectors of the market that are going to be impacted on a reduction in spending.
Right. Well, I'll leave it on saying that all this stuff is lining up for a type of path that seems almost predictable, where we get, let's say, a blow off top, we get a bunch of liquidity injected into the system, some external shock happens that causes volatility, some people get wiped out, blah blah blah, but there's still liquidity within the system. Bitcoin hits some high, S&P hits high, Nasdaq hits the high. You have this K-shaped economy, and then you have all kinds of political turmoil that happens because of the administration. It seems like that's the most painful way for things to move forward, a bunch of volatility and all these different assets forward. And why should it not go that way? Because it's gone that way over the last 100 years. So that's what I'm looking forward to. There is I like it because it's opportunities to make money.
Sure.
Like
that's
that's
why I
like
looking for on this channel. Yes.
Yeah. Just to button up on that, I wanted to mention the SMCI trade that we talked about back in November, where that stock was almost going to get delisted. It bounced basically the day we talked about it on Friday. It made a low, and then it rolls all the way back up to $46, like from I don't know, $12.
It's closed after market at $47.91, and on the way up for sure.
So just to mention, we talked about this is why these types of volatility in all these different assets, and why we're paying attention to it, because you could make that was a 400% move gain in the options space, and that's only by when we were talking about the options at the time. It wasn't even the best price you can get the options on. It actually moved up. Like these opportunities that exist in the market can reward you for expressing a trade and not just consuming the news. Same thing with Monday.com, same thing with Nvidia, all these different things. So
Sure.
I thought it was a nice victory lap that the price moved basically exactly to where we were talking about.
How good does the SMCI team feel right now? We didn't get delisted.
Well, now there's the possibility that they might still, because it moved up because of the idea that they were going to meet their filing requirements, their deadlines, but they might just be saying that. So like, here's where I would sell my option and then buy a put, like take maybe 10% of the money you make on the call, buy a put, and then if it does fall, you'll make even more because it'll fall all the way straight down to bankruptcy.
That's right.
That's the fun ride of these of markets.
Yeah, for sure.
So let's take a moment to shout out TradersPost, the automated trading platform designed to take the friction out of executing your strategies. Whether you're trading stocks, futures, or crypto, TradersPost connects seamlessly to your broker or exchange, giving you the flexibility to automate your trades without missing a beat. If you're tired of being the bottleneck in your own success, it's time to let automation do the heavy lifting. Head over to traderspost.io and see how easy it is to streamline your trading. Okay, now I feel like a real podcaster. Not that there's an ad break inside of it.
Yeah, we got an ad break in the inside. I like it.